So let's have a look at part two of this weekly update. So I have a couple of watch lists. I made one update of a watch list yesterday. I'm going to attack the second one. Again, this is for the week ending March 8th, the first week of March, taking closing prices at the beginning of the week and closing prices at the end of the week to determine which ones have done okay. And then we're going to do some statistical analysis by dividing, you know, the analysis into parts. What stocks went up the most? What stocks were flat? What stocks went down the most? Helps us analyze the trades going into next week. Stocks that have been going up will be analyzed in terms of continuation. Stocks that are going down will be analyzed in continuation, and stocks in the middle as building momentum or changing momentum. So they may be more prone to change than the others. So the analysis starts with those stocks that tended higher over the week. The very, very top is the Nat Gas ETF, which surged 40%. They've told me, meaning the experts, as you probably are aware, natural gas is something that's very difficult to trade, trades in ranges and very volatile. Speaking of which, volatility for the CBOE, volatility for the Dow Jones, uh, volatility for Amazon, and effectively volatility uh, ETFs or stocks went up concomitantly. So there was a lot of volatility. Those are unusually large moves. Beyond the unusually large moves for volatility covering Amazon, volatility covering Dow Jones, and volatility for the near term for the whole market, aside from those that were up, we noticed that the SQQ, which is the ultra short ETF, and the ultra short mid cap ETF also made big moves. So people were betting on the Qs to go down this week. It was the correct bet, 16% move, 13% move for the mid caps. Solar Edge Technologies went up by 15%. A couple of marijuana stocks went up. They may have been on another watch list we've covered. I like to compare them, by sorting them in a different watch list. So we got solar went up. We got some marijuana that went up. We saw some pharmaceuticals. Moderna went up by 10 or 11%. Amgen went up by about 10%. And there you have it. These are stocks I'm looking at because they went up so considerably that investor interest is going to increase. The likelihood that they continue to increase at a high pace is small, but it might be worth looking at. The alternative strategy is to compare this weekly move with the monthly range and see if perhaps they are recovering from being on the downside. So, a lot to do with this information. We'll do a midweek update for you to see how they went. And without jumping to conclusions, the higher the percentage move, so microchip technology making a 13% move might be something I'm considering looking at as a hold or a sell, because at the end of the day, uh, investors may be trying to get as much out of the market now rather than think of it long term because of the speculation that we could be entering a downturn. So I'm not going to go into that. I'm not a financial advisor. I'm just telling you that I have to show you both sides of the argument. Just because the stock is going up doesn't mean it's going to continue to go up. We need to look at it in context and apply logic. Let's move on to those that are going to the downside. Thank you for watching. Hit the like and subscribe. Let's take a look at those numbers about stocks going down, and I'm a little amazed. The breadth and depth of stocks going down is higher than the breadth and depth of stocks going up. From bottom to top, Hewlett Packard got smashed, closed at $15–16 range after opening at the $20 range. Investors are hesitant to get into these names of IT until they sort out what is the actual prospective growth in a bad economy. Always something to monitor because you don't want to be the last to get in when it's at this range, nor do you want to be the first and it continues to go down. Uh, of course, you don't need me to tell you that. If you like a stock, you got to watch it every day, maybe even hourly if you're a professional trader. Hewlett Packard is the one we're going to have to take a look at. We're going to look at ARKK, which is the Cathie Wood. That went down by 20 bucks, but I think over the year it had been pretty good. We're going to look at American Airlines Group. It's been beat down. We're going to look at Delta Airlines. So the airlines have been beat down. It's now time to take a close look at. And of course, the big three at the top are Amazon, Netflix, and Nvda. What the hey is going on with those stocks? Those are long-term investments. Netflix trading at $800 Nvda at 100, Amazon close to 200. It's crazy, crazy, crazy. This is the week where you're going to have to really bear down and look at these stocks closely. Without further ado, let's go to the next segment. Those that didn't change too much. Let's take a peek at those mid-range stocks. So these are the stocks we believe are going to make its mind up. Where we're going to go up, or we're going to go down. Um, okay, we're looking at stocks that really traded flat. There's a 1/4% move to the top, or 0.5% move to the bottom. Let's go right to the middle. Box. Box is a IT company, focuses on storage as far as I'm concerned. You can do the research, due diligence yourself, but that's a stock that I've been tracking personally, so I'm going to pay attention to it. It seems to be stuck. That means it was either going up or going down. Now it's stuck. Buyers and sellers are waiting to make a long-term decision on it. I'm looking for increased volatility, if anything else. That's good for options, so I want to get in rather than at times when it is highly volatile. Please leave your comments and subscribe and let me know what you know about Box. Let's look up a little ways from Box. Box went down about 0.5%. So the JD.com is a very popular IT company, kind of like the Amazon of China. I'm going to keep my eye on that. I got at the very bottom lithium, Piedmont Lithium. I like to track those. Lithium is something that goes into your electric batteries. Okay, utilities ETF kind of went down a little bit. I imagine that's going to recover. My understanding is during bad economies, utilities are a safe play. So we're looking at Box, JD, Piedmont Lithium, and utilities on the way down with a chance to turn things around. Moving up from Box, I like to look at the bigger priced stocks. So Open Text Corporation traded at 26, relatively flat. We're looking at a healthcare ETF trading flat this week. We're looking at the junk bond ETF traded fairly flat. And my understanding of the junk bonds is that that tends to do well. Probably, probably when there's some interest in the economy towards volatility is my understanding. Now let's go to the very top, short-term corporate bond ETF and the high-yield municipal bond for corporations. So, I mean, look, You do the math, you do the analysis. I've given you a few examples of stocks that are flat or ETFs that are flat. It's up to you to do the analysis. Now I'm going to pick one or two like I did in part one and do a deep dive into the charts. I think that I'll let you know. I'll let you know what we're looking at in the next slide. Can we get a Dave Grohl, the Foo Fighters drum roll? Yes, he used to be a drummer. Everybody knows that. I think he played for Tom Petty, or almost did, then did his own thing after playing with Nirvana. The drum roll is Amazon. We're looking at the Amazon stock. I'm looking at this very carefully. It's a long-term play for every investment bank on the planet, and most 401ks will have it. So this is a stock, probably, in my opinion, that will make moves and important to look at. To the left of the chart, around February 28th, the stock was trading in the $207 range. It hung out there for a while. And that's not even a range, that's a price. That's a very strong price. Okay. You'd be hard pressed to find people that don't want that stock now because of the stability at 207. It made a precipitous drop, as you can see, March 3rd and 4th. That's a fear sell. It started to make some recovery to the 207 price we like. That's good. That means that's where the price will tend to go. It even did it in a gradual manner, which shows strength in that direction, no choppiness. It came back down to its low of 200, though, in a bit of a choppy manner. It went so far as to test the 195 level, which on this chart here shows a lower low. When you see lower lows and lower highs, you are in what amounts to a bearish territory. Bearish territory, and the new price of interest seems to be not 207 anymore, but wherever you see it's hit 2 or 3 times. So on March 4th, it hit the 200 price range. It did so again March 6th, about 2 or 3 times. March 7th, it hit it 2, 3, 4, 5 times. So it looks like the stock wants to catch its breath before going down here at this price of 200. 200 is the new price of interest. Um, it looks like a bearish chart to me. It looks like it's one of those interesting charts. I'm going to now zoom out and look at a bigger picture because this is of significance to me. The Amazon chart is something that bears some, significance and explanation. The vertical lines from left to right are places where the volume traded per day was the highest out of the past year, not to mention the previous 6 months. So those are points of interest. I wrote the dates down on the left, so that if you have time and you go into your own charts, you'll be able to see those dates. But over the past year, February 7th stood out. Price rejected a little over 235. We'll call it 240. To the trained eye, this stock looks to be ready for a turnaround. And I say trained eye because if you'll notice how the stock performs, it tends to go up to a point, go down to a point, retest the point, come down to a point in a channel or a range. So the range that I'm looking at begins at the 220 price level from left to right. 220 to 230, came back to 220, went up to 230, came back to 220, went up to 230, came back to 220, maybe a little below, went up to 230. That's the range. Now it has gone down below 220, and the math says that it's going to, go down to 210 and maybe go back up to 20. But now not only did it go down to 210, it's gone down to 190. Okay, so at that, I'm sorry, 200. So at that 200 price, it went up to 210. It's gone back to 200. I like the fact that the stock gives you defined ideas of where to go. We know the stock is either going to 210 or maybe 190. Again, the conclusion is if you're going to do a safe bet and you analyze the amount of volatility on the stock. Volatility means the ranges of prices are going to be high, and ranges of volatility to me are marked off by high volume traded days, February 7th, December 20th, 2024, November. Let me be more specific and tell you as I scroll over to my chart that we're looking at definitely December 18th, February 7th on the right. Um, yep. And went as far back as November 20th. So I have three vertical bars from November 20th. November 20th is the far left. Uh, December 20th is the one in the middle. February 7th on the right. I'm uh, I'm really coincidentally going to recommend the same trade I did on eBay. Due to volatility and knowledge of ranges, it'd be silly not to use that information. You can guess what we're doing, and we'll meet you at the next slide. So for diligence, due diligence, and of course, to satisfy those ones that want a clear picture, I'm going to attempt to review this slide one more time with you in greater detail and more slowly. Okay, the price on the right is at 200. The price on the left, coincidentally, is 200. But if you go all the way back, it goes up to about 210. 210, 200. That's a leg down. Goes up back to 210, uh, makes a move equal to the leg down in the other direction. So the mean price I would say is right around 220. So it goes up to 230, comes down to 220, up to 230, down to 220, up to 230, down to 220, up to 30. That's a clear range. The stock likes to trade in that range, $10 range. It pokes its head up by about $10. Wouldn't it make sense that it comes down $10 below the low? Well, it did. It comes down to 210. That range is now clearly defined. The stock wants to trade between 210 and 240. On average, that's where it's traded for several months. That's its range. It's poking its head below, just like it did down here. Well, there's a new range over on the left, okay? The range is below or above, okay? The ranges are well defined to me. Mathematically, the average is right there. Average is trying to creep down. It's bearish. It's eventually, if not oversold now. And there's got this big yellow line here. It's a longer term moving average. People don't like to see that broached. So the safe play is I'm going to play one to the high side, one to the downside. Understood? Let's get this party started. So like we did with eBay, I'm going to take us to the downside first. Let's look at a ticket. Amazon, we said, is trading around the 199 to 200 range. We know that it moves in ranges of about $10. What's the put down to the downside going to cost us? 136 for the 190 put. Okay, I'm going to buy that. I'm going to sell the 187.50. What does that mean? That means if the price goes from 190 to 187, it's about 200. That's $2.50 or a $200 move. That's it. I got to sell it. I can own. So the option means I have the right to own it between the price of 190 and 187, capping out my maximum gain to whatever 250 minus 136 is. 150, about 100% gain. Okay. Um, not only is it the case that particular leg is in play, but in this particular spread, I'm attaching another leg down. So basically, I'm putting together the other side of the butterfly, which is a credit spread. So I don't believe the stock is going to go down as low as 187.50. Okay, so I'm going to sell a put and buy the 185 put. So I'm getting a credit of 97. That credit of 97 is in my pocket, but I'm buying the one below it, so I'm getting 25. So I'm paying 25, okay? Technically for that spread, if I'm reading the numbers correctly on here. No, I'm getting a credit of 25. Sorry. I'm putting 25 in my pocket for the bottom leg, And I'm funding the top leg, which is costing about 38 bucks, 38 minus 25, whatever it is, 13. I'm paying 13 for this trade. I'm going to get out, of course, before the trade, starts getting close to 187. I'm trying to get out as soon as it gets close to 187. Ideally, it closes 187. I make my 100% profit. To the downside. Any questions? Answers? On the plus side, I know that Amazon trades in ranges. It closed at about 199, 200. It has a tendency to go up by $10 and hang out in range to 200, not much above it. Because the stock was trending in the down direction, you notice the price of this order is relatively inexpensive. It's inexpensive because people don't expect it to go up at this point. That's just the math. That's why the stock pricing works. So the price of the call at 207.50, that is to say the right to own the stock at 207.50 during the term of the contract, which I've got expiring on Friday. The stock goes up to 210, for example, by Friday, I've made $250. The price of that contract is the difference between the midpoint of the bid and the ask on the 207.50 or 134 minus 89 cents, which is what I'm getting for selling 314 210 call. 134 minus 89 is 45 bucks. Notice at the bottom the estimated amount of the trade is 14, not 45, because I'm funding the $45 trade with the prediction that the stock will not quite make it to 210. So I'm selling the 210 call and buying the 212.50 call. Like before, I take 89, which I'm putting in my pocket. I'm buying the 58. Difference between 89 and 58 is 31. I'm using those $31 to fund the trade on the top side. So I'm getting a discount. I'm paying $14. I'm getting out as soon as the stock gets close to 210 and above 2750. Any questions? Answers?